Good day, ladies and gentlemen. And as we get started today's webinar, I would appreciate it if you could click on the bell icon below to allow notifications so that you'll be notified whenever I upload a new class, or subscribe. I would greatly appreciate if you would subscribe to my channel. I promise you, we're not going to barrage you with emails. You'll just get notified when I put a new class up. So today we're going to be discussing mastering price action with charts. And understanding and reading a financial chart is about one of the best things, or the basic things you have to be able to do when you're trading in the financial markets. Whether you're trading stocks with a stockbroker, whether you're looking at your pension fund and your retirement funds and how they're invested, or you're going to do online trading. As recently as the 1980s, brokers and traders charted movements of asset prices by hand. Now, when I started trading in 1972, we would sit there with graph paper and watch the ticker tape as the prices come in, and we would put these on our charts. So we only followed a couple assets, and it was a very time-consuming process. But remember, there were virtually no computers, or in those days, computers took up a great big air-conditioned room, and there was no internet, and there was no PC, there was no Windows. So in less than 4 decades, the charting industry has been revamped several times over, which has led to intricate, complex tables that traders decode today before executing trades. Today we have all the up-to-minute data, as fast as professional brokers, as fast as those guys that had those great big rooms full of air-conditioned computer equipment on MS-DOS. Today we get everything, and the new HTML and Java charts allow us to set them up, customize them, put indicators on there, have the data feeds right. A lot of brokers allow you to trade directly from their live charts. So you have to understand charts, and charting is the bare basics, is the most important thing you can do. Why? Well, in order to read financial charts, in order to understand price, you need to understand what the charts are telling you. So it's an absolute necessity carrying out intelligent trades. Without it, trading currencies or trading any assets would be a lot more gambling, highly dictated by chance. Now, sit back and imagine. I'm going to tell you right now that the euro is trading at 111.42. It opened the morning at 111.39 and went down to 111.37 and went back up to 111.49, went back to 111.52, closed at noon at 111.44, and then fell down as low as 111.32. Now, can you repeat that to me? Can you even tell me what the euro actually did? Do you have any idea where it's going? No, because our minds cannot interpolate that data. It can't interpret it. We understand the numbers, but we can't see all of those numbers. So financial charts are really graphic depictions of price movement. And so you have to be able to learn how to look at these price charts and understand what price action is trying to tell you. Now, first, there is a lot of difference between the charts that are available on the market. But today, like when I traded, back in the early 70s, and we were trading by hand or charting by hand, you could only draw one kind of chart. And there weren't many choices. There's still not many choices. But I drew bar charts. Okay, and that's all I did. Today, you can start off with bar charts, click a button, it'll be converted over to candlesticks, click another button, it'll converted back to a line chart. Everything is in one place and easy to do. You can also overlay indicators and oscillators directly on your chart. You can change trend lines, levels of support and resistance to understand and interpret price. So if you think of technical indicators as the interpreters of price, they help you when you can't figure out what price is telling you on the price chart, and an indicator will serve as your interpreter. Like at the UN, somebody's speaking, you speak English and they're speaking English, but English isn't your primary language, so you have a headset on and you have an interpreter in the back room trying to help you follow along and make sure you understand what you're hearing. Now, charts come in 3 basic styles. Line chart is the most simple. There is virtually no reason for us to use a line chart. It doesn't give us any information. Now, I'm going to qualify what I say because today these IT developers who aren't traders, they're programmers, have given us way too many choices. And sometimes too many choices isn't a good thing. Okay. So before I qualify line charts, we have bar charts and candlestick charts. Candlestick charts have been around since the 1700s, but they weren't primarily used in online trading and in trading, when we had the hand chart, because it was time consuming to draw these candles on. So the most popular type of charting then was the bar chart. But let's go over to a live chart and let me explain it to you there where it's easier for you to see. Okay, so we're looking at a candlestick chart. Before we go on to the more complicated ones, I'm going to click on a line chart. Now, price is price is price. Price doesn't ever change. It is what it is. It's a historic fact. So this line chart is the same as the candlestick chart, using the same numbers as the candlestick chart. But this line chart has used just the close of the time frame for that price. So we're looking at a 1 hour chart. So every 1 hour a dot is put on the chart at the close. And that number's then hooked together. But you see, all of my life, bar charts have always been based on the close. But some brilliant IT developer decided to give us more choices. So we can choose from the open, the high, the low, and the close to make the line chart. We can choose the high and the low divided by 2, the high, low, and close divided by 3, or the open, high, low, and close divided by 4. A lot of stuff. Too many choices because a line chart isn't really used for any analysis. It just simply shows you where price has been because it doesn't have enough detail. So to give you all of those complex choices is kind of redundant. So on the whole, everybody uses or quickly uses when you're losing a line chart is the close of that period. Okay. From there we go to, which is my favorite, or was my favorite for many years, which is the bar chart. Now this bar chart uses the same exact data, the open, the high, the low, and the close. But all 4 of those pieces of data are plotted on that little bar that is then put on your chart. So you can start to see a lot more commonality. You can start visualizing or seeing price movement. You can start to see where there's some common prices. You can start to see what price is doing, because price isn't just the close. It's all about price levels and how high it's been, what the low's been, how big the move has been, and you can start to see that in a bar chart. So a bar chart gives you more information and gives your eye visually or graphically a lot more understanding of what price is doing. From there we go over to the candlestick chart. Candlestick chart is the buzzword in I just messed up my chart and I don't know if I can go back. Oh, let's see if I can undo what I just did. I don't think I can. Okay, I guess I'll just have to do it again. It wasn't for this class, but it's all right. But the candlestick chart now employs colors, and these drawings at each time frame, still using the open, high, low, and close, are called candles. And we now have the body of a candle and we have the wicks of the candle. But because they're pretty to look at, they became the buzzword of online trading. Now, when I started trading, we didn't deal with candles. It's not we didn't. They were too time consuming to draw on your chart. But today we can jump between one to the next, to the next, to the next, to the next by just simply clicking on the buttons on our chart. So we can go back over to a line chart real quickly. We can go over to bar chart real quickly. Okay. But once you've understood the difference in charts, chart types, you have to understand time frames. Now we're looking at a Euro US dollar on a 60-minute chart. That means every 60 minutes we're putting the open, the high, the low, and the close for that 60-minute period, but only that 60-minute period. Okay. Now, nothing changes when we change it to a half-hour chart, except we see a whole bunch of different price movement, because now each one of these lines represents a half hour in that hour. So in an hour you would see, let's go back to the hour. Okay, so let's take the most current candle right here. You're seeing right there what the Euro US dollar traded for in that 1 hour period. You're getting to see the open, the high, the low, and the close for that one period. But that's the open that it opened 1 hour ago. It's the close that it just closed. It's the highest it reached over that 1 hour period, and the lowest it reached over that 1 hour period. Now, hypothetically, what happens if the first 30 minutes of that 1 hour period, it stayed near the highs and stayed all the way towards the top, and the second half of that half hour, it went all the way down to the lows? Well, if you're looking at the 1 hour chart, you wouldn't see that, because you'd only see the whole movement for that whole sector. Whereas if you break it down into a half hour chart, now what you're getting is you're getting two candlesticks that cover that 1 hour. So you're getting to see more detail on that price movement. Okay. Now you have to learn how to use candlesticks, how to use time charts and what time frames work best for you, but you have to understand that they exist. Okay. We can also then put indicators on our charts. Like we can draw Bollinger Bands right over top of our charts, or we could go down and put MACD on the bottom of our charts. These are technical indicators. Okay. But these are mathematical calculations, and they're called indicators, but there's only one small field of chart analysis. We can also look at putting things like support and resistance on our charts, trend lines on our charts, to isolate where we expect price to move and bounce from or before, and to isolate the highs and the lows of where that price moves over a time period. We can also put what we call chart patterns on our charts. These are like a triangle pattern that's appeared here. When we see a triangle pattern, we can interpret it because that's standard. It's the standard movement, because remember, price is all about the traders. It's all about human psychology and what buyers and sellers are willing to pay or sell a price at. And so we have all types of market structure that we can see within our charts. So chart analysis is the backbone for understanding and interpreting price action. So we've looked at the three different types of charts, and we talked about the line chart, we talked about the bar chart, and of course we talked about candlestick charts. Now remember, candlestick charts show the same information as a bar chart, but in a different graphical format that is kind of fun to look at. Candlestick charts indicate the high and the low of a given time period, just as a bar charts do. So a candlestick or a bar chart starts out with the high of the period, the low of the period, the open of the period, and the close of the period. The difference is when you're using a candlestick chart, if the open was higher than the close, in other words, price stepped down over that period, you would fill it in with red. If the close was higher than the open, it was a positive period or a bullish period, and you'd fill it in with green. So candlestick charts are highly informative. It's not the only information every chart element contains, but also regularly repeated patterns that help traders see oncoming changes. These patterns help to see short-term direction and predict the bullish and bearish trend. So the structure of all trade charts is pretty much the same. They're on an XY axis, and they only have, everything in the market only has basically 5 pieces of information: the open, the high, the low, and the close for the time period you're looking at. And those are historic prices that once they've happened, they don't change. And the volume, the trading volume. So whether you're using an indicator, an oscillator, whether you're putting support or resistance on your chart, whether you're drawing a trend line, they're all based on those numbers, because those numbers are the only for sure things in the marketplace. So before we move on to price action, you need to understand that bar charts also have patterns. Most traders focus on candlesticks and forget about bar charts. But like I said, I like bar charts. That's where I started a long time ago, but I flip back and forth, and I use both today. But as we discussed earlier, open, high, low, and close are the only numbers. So as you can see, bar charts have patterns. You have to learn how to see them. But again, it is the width of the move and the comparison to the next bar on your charts. Candlesticks do the same thing. We have candlestick patterns. So it takes a bit of practice to get used to reading a chart, because price is moving quickly. But now that we know what charts we have to start to use these charts. So what is price action? Price action is the movement of an asset's price plotted over time. Price action forms the basis for all technical analysis of a stock, a commodity, or other asset chart. Many short-term traders rely exclusively on price action and the formation and trends extrapolated from it to make trading decisions. Technical analysis as a practice is a derivative of price action, since it uses past prices in its calculations that can then be used in informed trading decisions. But I take the word technical analysis and throw it in the trash. Not because I know anything better than anybody else. I just rename it to chart analysis, because technical analysis is anything and everything we do on our charts. So chart analysis is a lot less scary than technical analysis. So price action analysis is the act of studying, reading, and interpreting the price movement of a market over time, which involves the use of raw price charts to trade the market. By learning to read the price action of a market, we can determine a market's directional bias as well as trades from reoccurring price action patterns. Price action analysis is used of raw price movement. So in simpler terms, all economic variables create price movement, which can be easily seen on a chart's price. Whether an economic variable is filtered down through a human trader or a computer trader, the movement that it creates in the market will be easily visible on a price chart. Therefore, instead of trying to analyze a million economic variables each day, you can simply learn to trade from price action analysis, because this style of trading allows you to easily analyze and make use of all the market variables by simply reading and trading off the price action created by said market variables. Price action generally refers to the up and down movement of an asset's price when plotted over time. Different looks can be applied to a chart to make trends in price action more obvious for traders. Now that's a lot of words, but imagine you have your domestic partner, your wife, your husband, whoever you live with, and you've been together for a long time. You also have a couple kids. Okay. When they walk in the door, you can kind of look at their face and interpret what's going on. You can, in a conversation, you can see their eyes light up, their smile. You can see if they're happy, they're unhappy. You can see if they're, feeling well, not feeling well. Your partner walks in, and you can, in 2 seconds, you can say, "Uh-oh, bad day at the office. What happened?" This is what happens with price action and looking at price charts. Now, technical analysis is the variable of knowing things or putting stuff on a chart. So if in the morning your husband had said to you before he left, "Well, I have a big meeting with the boss at 1 o'clock," and he comes in the door looking gruff, you can analyze the meeting with the boss wasn't so good. But if he told you in the morning he had a meeting with his staff, and then he called you in the afternoon and told you, everything went great and he got a promotion, and then he comes in the door looking pretty gruff, you can kind of figure out what happened. There's probably bad traffic on the road home. Okay, so by seeing these factors, you can interpret your spouse. So you can do the same thing by understanding the personality of an asset by looking at price. Price action can be seen and interpreted using charts that plot price over time. Traders use different chart compositions to improve their ability to spot and interpret trends, breakouts, and reversals. Many traders use candlesticks since they help better visualize price movement by displaying the open, the high, the low, and the close. So like when you're trading candlesticks, there's certain patterns: bullish engulfing, bearish engulfing, harami. Okay, these are patterns or facial actions, things that you can see in your partner's face. That smile, the eyes lit up. Okay. The typical price action chart with candlesticks and bar charts at the bottom showing volume. Okay, but we can interpret price action by looking for patterns and what we call chart patterns. These are patterns that reappear in the movement of an asset over and over and over again, historically over a great deal of time. We have triangles, we have head and shoulders, we have bearish tops, we have double tops and triple tops and cup and handle. But these, and rectangles, these happen over and over, and by historically looking at these patterns, traders have come up with how a human being normally reacts historically when these patterns evolve. So it's really a visual interpretation of the psychology of the markets. So when we see this pattern appear the next time, whether it's 2 months down the road or a year down the road, we can put that to action. So in addition to the visual formations on the chart, many technical analysts use price action data when calculating technical indicators. The goal is to find order in the sometimes seemingly random movement of price. Price action is not generally seen as a trading tool like an indicator, but rather as a data source of which all the tools are built. Swing traders and trend traders tend to work most closely with price action. Even these traders must pay some attention to additional factors beyond the current price, as the volume of trading and the time periods being used to establish levels of all the impact likely on the market. Now, interpreting price action is very subjective. It's common for two traders to arrive at different conclusions when analyzing the same price action. One trader may see a bearish trend, and another might believe that the price action shows a potential near-term turnaround. Of course, the time period being used also has a huge influence on which traders see price action and charts, stocks, and assets. The more tools you can apply to your trading prediction to confirm it, the better. In the end, however, the past price action of a security is no guarantee of future price action. High probability trades are still speculative trades, which means traders take on the risk to get access to the potential rewards. So thank you very much for joining us, and please subscribe to my channel and watch my other videos. I do them all the time. Lately, I've been doing more and more. And so please take a look at all of them. Bye now.